10 years. That is the window. Most people will spend the next decade doing exactly what they did in the last one. They will trade time for money, call liabilities assets, buy things that depreciate, and then wonder why the scoreboard of their life barely changes. I would not do that. I have spent most of my life thinking about assets, and I can tell you that the word is misunderstood. People think an asset is only something an accountant recognizes on a balance sheet. That is too narrow. A real asset is anything that grows in value or throws off returns over time. Sometimes it is a stock certificate, sometimes it is a parcel of land, sometimes it is a business, and sometimes it is something much less visible, like a reputation, a skill set, or a family system strong enough to preserve wealth instead of destroying it. That is where I want to begin. The first mistake most people make is they chase the visible asset before they build the invisible one that makes every visible asset possible. They want the stock tip before they have the income to fund the account. They want the rental property before they know how to read a deal. They want the portfolio before they have the temperament to hold it. That is backwards. Wealth is not built by collecting random things and hoping they all rise. It is built by owning assets that either compound, protect, or produce. And over the next 10 years, the people who understand that difference are going to separate themselves from the people who keep confusing motion with progress. Now, let me walk through the assets I would take seriously if I were building wealth for the next decade. I want to begin with something most financial people ignore, because it does not have a ticker symbol. Your children and the quality of the thinking you pass into them. That is one of the longest duration assets any family can own. Most people think of inheritance as money. They are wrong. Money without judgment is often just a delayed disaster. Study wealthy families over multiple generations, and you find the same sad pattern. The money arrives, but the wisdom does not. Communication breaks down, trust breaks down, discipline disappears. The second generation spends what the first generation built, and the third generation tells stories about the fortune that used to exist. That happens far more often than people want to admit. The problem is almost never the original capital. The problem is the next generation being unprepared to carry it. So when I think about investing in children, I am not talking only about tuition. I am talking about teaching them how money works, how to delay gratification, how to think in decades instead of weekends, how to judge people, how to avoid marrying chaos, how to recognize predators, how to distinguish status from substance. A child raised with that sort of internal discipline is a stronger long-term asset than many portfolios I have seen. Money survives only where judgment survives, and if you do not transfer judgment, then eventually the money goes too. Now let me move to something much more immediate: artificial intelligence, automation, and the ability to use them as leverage. I want to be very precise here. AI itself is not going to make most people rich. Owning a chatbot subscription does not magically improve your life any more than buying a hammer makes you a carpenter. But the person who learns to direct these tools, the person who can turn 10 hours of labor into one, the person who can use automation to widen the gap between effort and output, that person will have an enormous advantage over the next decade. What interests me is not the technology as spectacle. What interests me is leverage. If one person can produce what used to require a team, then that person can free up time, increase output, improve margins, and pour the resulting advantage into every other asset on this list. That matters enormously. The world does not reward effort in the abstract. It rewards productive output that somebody else values. If AI lets you produce more of that output while spending less time to get there, then it becomes an accelerant on human capital. I do not think the winners will be the people mindlessly using AI to avoid thinking. I think the winners will be the people who think clearly enough to use AI as an extension of judgment. That is a very different thing. The next asset is one of the most underrated in the whole list: buying a small business that already works. Most people hear the word business and immediately imagine starting one from scratch. The garage, the ramen noodles, the heroic uncertainty. Fine, I admire builders. But there is another route, and it is often much less romantic and much more profitable. You can buy cash flow. There are thousands of profitable small businesses owned by people who are tired, aging, or ready to retire. Cleaning companies, niche software providers, local services, boring industrial operations, unsexy businesses with real customers, real invoices, and real cash flow. Most never make the news. Most are sold quietly. Many can be bought at modest multiples compared with public equities, and many owners care less about a flashy exit than about continuity that creates opportunity for someone who knows how to read a business and improve it. Buy one with steady earnings. Use the business's own cash flow to pay part of the purchase price. Add systems, add digital tools, improve sales discipline, reduce waste. Then either keep the cash flow or sell the improved business later at a better multiple. That is not theory. That is a very real path to wealth. And it skips the years of startup uncertainty that destroy many new ventures before they ever become assets. Now, let us shift from building wealth to protecting it. Alternative stores of value, gold, Bitcoin. Hard finite things outside the normal banking system. I do not think these are vehicles for getting rich quickly. I think they are insurance policies against the oldest trick governments know, diluting the currency while pretending they are solving a different problem. Every paper currency eventually loses purchasing power. That is not cynicism. It is monetary history, states print. Debt gets inflated away. Savers who sit entirely inside the paper system quietly lose. The people who own scarce stores of value at least have a fighting chance. Gold has preserved purchasing power across empires, wars, defaults, devaluations, and political stupidity for thousands of years because it cannot be created on command. Bitcoin is different in form, but the attraction is similar. Fixed supply, portability. No central bank deciding there should suddenly be 20% more of it. I am not saying put half your life in these things, I would not. But I would also not remain 100% dependent on a system whose operating logic is to solve its own problems by weakening the unit you save in. 5 to 10% of investable assets in something finite and difficult to print is not extremism. It is prudence, and it protects the rest of the portfolio from being entirely at the mercy of monetary politics. Now let us talk about land, productive land, farmland, commodity land. This is one of those assets people ignore because it is too tangible to seem exciting. That is precisely why I like it. A productive farm has two traits I value enormously. It can generate current income, and there will never be more of it than nature permits. If the land is farmable, useful, and in the right area, then time tends to work in your favor. Population rises, food demand rises, productive acreage does not magically expand. That scarcity matters. I bought a farm in Nebraska years ago because the economics were obvious. I did not need to drive the tractor. I did not need to become a farmer. The land could be leased to someone who knew what to do with it, and each year it would produce both output and rent. That is a lovely combination. It is not a flashy asset, it is a durable one, and durable is better. Now the next category sits much higher on the risk curve, private equity and angel investing. This is where some of the extraordinary returns live, but it is also where experience, access, and emotional control matter a great deal. By the time a company becomes available to the public markets, much of the greatest upside has already been captured by earlier investors. Private markets are where that early upside lives. But I do not romanticize this area. Most people should not rush into it. Early stage investing can produce extraordinary outcomes, but it can also produce zeros with impressive efficiency. Private equity in established private companies can be more grounded, but it still requires strong judgment and access to decent opportunities. So I do not put this near the top of the list for most people. I put it here because over a 10-year horizon, anyone serious about wealth should at least understand that the greatest gains often occur before the public sees the story. The point is not to write reckless checks. The point is to build the sophistication, network, and reputation that eventually allow you into better rooms. And that brings me to something most people talk about sentimentally and almost never value correctly. Your reputation and your network. Those are assets, very serious assets. A good network is not your contact list. It is a group of people who trust you enough to send opportunity your way. A strong reputation is not being well liked in some vague social sense. It is people believing, based on evidence, that if they bring you into something important, you will not damage them. That matters more than almost anything else. The best deals rarely arrive through public channels first, the best hires, the best acquisitions, the best partnerships, the best introductions. Most of them come through trust networks. Somebody makes a call because your name means something useful to them that is leverage money alone cannot buy. And like every good asset, it compounds if you handle it correctly. Keep promises, show up prepared, do not be sloppy with other people, as time or capital. Act in a way that makes people comfortable staking some of their own credibility on you. That is what builds a reputation. Once you have that, your network stops being decorative and starts becoming productive. Now we come to a modern asset class many older investors still underestimate: attention, digital assets, audience trust, a website with real search traffic, a YouTube channel with durable viewership, an email list people actually read, a software tool, solving a narrow problem, a niche community that trusts your judgment. These are real assets because they generate distribution. And in modern business, distribution is leverage. If people come to you directly without you paying for every interaction, you hold something very valuable. You own a little stream of attention. You can monetize it through advertising, affiliate relationships, products, services, partnerships, or the simple power of directing people toward what you own. That is real. Now, I want to be careful. Attention without trust is fragile. Virality is not an asset by itself. A huge audience that would never buy from you, never listen to you, and never trust you is much less valuable than a small audience that does. That is why audience trust matters more than raw reach. 1,000 people who truly trust you can be worth more than 100,000 who barely remember your name. And in the next decade, attention will become more scarce, more fragmented, and more contested, which means own distribution will become even more valuable. Closely related to that is intellectual property. This is one of the purest assets in the world when it works. You write a book once and sell it thousands of times. You create a course once and it keeps generating cash flow. You license an idea, you patent a process, you build software, you package specialized knowledge into a form that can be distributed repeatedly at almost no additional cost. That is a wonderful economic characteristic. Most businesses require more labor and more capital every time you want more output. Intellectual property can scale with astonishing efficiency. The catch is that it usually requires deep thinking up front. You need something worth packaging. You need enough expertise, originality, or clarity that people actually want the thing. But once you have it, the economics can be extraordinary. A good piece of intellectual property can outlive you. That is worth respecting. Now let us move to one of the oldest and simplest assets there is, dividend stocks. A good dividend stock is a business that pays you for the privilege of owning it. The business earns money. Management allocates some of that money back to owners. You receive cash. If you reinvest it, the flywheel starts. More shares, more dividends, more shares, more dividends. This is boring. That is why it works. The world overpays for excitement and underestimates patience. A portfolio of high quality businesses paying growing dividends can become a remarkable wealth machine over time, especially if you reinvest for years before you need the cash. The beauty here is that the business works while you sleep. No tenants calling, no employees quitting, no need to predict the next shiny thing. Just steady participation in productive enterprises, throwing off cash. Now, I care about quality here. I do not want dividend traps. I do not want companies paying unsustainable yields just because the stock is in trouble. I want boring giants with dependable economics and a culture of rewarding owners. That sort of portfolio may never impress the impatient. It does not need to. It is there to get you rich quietly. And if dividend stocks are the quiet engine, then the next asset is the great autopilot of modern investing, index funds and ETFs. I have enormous respect for these instruments. When used correctly, most professional managers, with all their analysts, expense budgets, and elegant language, fail to outperform broad low-cost indexes over long periods. That is not because the market is unfair. It is because fees matter, friction matters, and simplicity often wins. An index fund lets you own a broad slice of productive capitalism without having to guess every quarter which company deserves the next dollar. Weak firms eventually get removed, stronger ones gain more weight. The system evolves while you do something more important with your time. That is wonderful. If someone told me they had no desire to study businesses individually, but wanted to become wealthy over 30 years, I would have no trouble telling them to build a serious position in a broad low-cost index and keep adding to it. Most people make the process too complicated because complexity feels like intelligence. It is not consistency as intelligence in investing. And if you started a child with a modest amount in a broad accumulating index fund and left it alone for decades, the result would teach the power of compounding more effectively than almost anything else I can imagine. Now let us talk about the asset class that has probably created more millionaires than any other income. Producing real estate. There are several reasons real estate matters. One is leverage. Banks will lend a large portion of the purchase price against the property. That lets an ordinary person control a meaningful asset with a fraction of the capital up front. Another is that tenants can help pay for the asset through rent. Another is that inflation often works in your favor because rents rise while fixed. Rate debt stays fixed. Another is tax treatment, which in many jurisdictions has historically favored property ownership in ways salaried people rarely appreciate. Now, real estate is not magic. It can be misbought, over-leveraged, mismanaged, over-improved. But, well, bought income property held for a decade has made a great many people wealthier for reasons that are not mysterious. It compounds through rent, debt paydown, and appreciation working together. One decent property can become two, two can become four, four can become a portfolio if the investor has discipline. And unlike a stock, an intelligently financed property lets you use other people's money without apologizing for it. Now let us move even higher up the hierarchy, your own business, and more precisely your equity in it. This is where the ceiling disappears. When you work for someone else, your upside is constrained. You can become very well paid. Yes, but there is still a structure above you collecting disproportionate benefit from your labor. If the enterprise scales enormously when you own the business, the asymmetry changes. If the business becomes extraordinarily valuable, the upside accrues to you. That is why so many of the truly wealthy are business owners or large equity holders. They do not just collect wages, they collect the expanding value of the machine itself. Now, I do not say everyone must become an entrepreneur, that would be silly, but I do say that building a real business, something profitable, repeatable, and eventually operable without your constant personal presence, is one of the strongest wealth assets in existence. A business throwing off $500,000 in annual profit can be worth several million dollars depending on the industry, margins, growth, and transferability. That is how years of focused effort can turn into a life-changing event. Not because of salary, because of ownership. And that is an important distinction for anyone serious about wealth. Now let me say something most finance content neglects, because it is harder to monetize. Your health is one of the highest return assets you will ever own. If you are too tired to think clearly, too inflamed to work effectively, too sick to sustain effort, too cognitively dull to recognize opportunity, then the rest of the asset list becomes much harder to build or protect. Good health does not guarantee wealth. Poor health makes wealth much harder. This is not motivational nonsense. It is arithmetic. Healthy people tend to earn more, think more clearly, and stay in the game longer. They have more years for compounding to work, more energy for execution, better judgment under pressure, better resilience. That matters. Your body is the operating system behind every financial decision you make. If the operating system is damaged, your outputs suffer. So yes, exercise belongs on a wealth list, sleep belongs on a wealth list, nutrition belongs on a wealth list, preventive care belongs on a wealth list. Because if the next 10 years are the window, then the machine you are using to exploit the window matters every bit as much as the market you are investing in. And finally, the most important asset of all, your high-income skills. Everything on this list requires capital, or at least the ability to attract it. Capital comes from income. Income grows fastest when you possess skills the market values highly and cannot easily replace. That is the seed asset, the one beneath the others. If you earn $50,000 and save 10%, you invest $5,000 a year. If you earn $300,000 and save 20%, you invest $60,000 a year. Now the compounding engine is being fed at an entirely different rate. The highest leverage financial decision most people can make is not choosing a better stock. It is dramatically increasing their earning capacity. That means becoming excellent at something the market respects. Sales, software, capital allocation, negotiation, leadership, marketing, a specialized domain with economic leverage. Any skill where mastery expands the ceiling instead of merely making you marginally more competent. And in the coming decade, the best skills will have two traits. They will be difficult to fully automate, and they will be amplified by technology rather than replaced by it. That is where the real compounding begins. Because once your income rises meaningfully, every other asset becomes easier to acquire. You can fund the index, buy the property, write the angel check, acquire the business, build the audience, protect the family. The rest of the list opens because number one got stronger. That is why I put it first, not because it sounds inspiring, because it is the seed capital behind all the rest. So if I were summarizing all of this for someone serious about the next 10 years, I would say it this way. Teach the next generation to think, use AI as leverage, not decoration, buy cash flow when you can. Own some protection outside the system, respect productive land, learn enough to access private deals later, guard your reputation, own distribution, package knowledge, collect dividends, keep indexing, own real estate, build a business, protect your health, and above all, become more valuable to the market. That is the order. Now, if you ask me which 3 I would start on in the next 90 days, I would not say all 15. That is a good way to get inspired for 48 hours and accomplish nothing. I would pick 3, a high-income skill, a low-cost index fund, and 1 additional asset based on your current stage of life. Maybe digital distribution, maybe a dividend portfolio, maybe saving toward a small business acquisition, maybe attacking your health. If the machine itself is running poorly, the point is action, not admiration. Most people do not have an information problem anymore. They have an action problem. They know enough to start. They simply do not. And that is why the wealth gap keeps widening. It is not just intelligence, it is execution. The wealthy are not always the smartest people in the room. Very often they are just the ones who moved while everybody else was still thinking about moving. That is the final rule. The next 10 years will reward assets, but only if you start acquiring them before the decade is gone. I would begin now.